Hello, everyone, and welcome to Mish's Market Minute, sponsored by StockCharts TV, our weekly segment. And this will be our last live weekly segment of 2021. So I thought, what better way to do it but to take another deep dive at the macro and try to prepare for what could come at us in the first quarter, at least, as we get into 2022. So I'm calling this the Grinch that stole the Christmas rally.
So let's talk about the Grinch. We still have some time left this year to find some volume to the upside, but it seems like our best shot is really going to be some of the members of the economic modern family. So we're going to really go through that economic modern family. Obviously, we have to look at what's been leading for years now, which has been the FANG stocks and NASDAQ. Will they continue to lead, or is it time for some new members of the family to come alive? We also have to look at rising commodity prices, given the comments of Jerome Powell this week. He actually didn't use the word transitory, but he's still seemingly taking a somewhat transitory viewpoint of inflation as we get into 2022. So we're going to take a look at some of the specific commodities. We obviously have to look at the interest rates through my favorite ways of looking at it, which is not only the long bonds and the 10-year treasuries, but also even the junk bonds. Must take a look at the dollar. That's a key player. We'll take a quick look at Bitcoin, which seems to be running sort of alongside of SPY. And finally, since people think that we're going into a much more volatile period, we will take a look at actual volatility. And here are the symbols that we're going to cover for you to have a look at. Okay, let's switch to the charts. So let's start with the, what I always like to call the granddaddy of the modern family. And I've just put out the perspective here because it's really important to see what's been happening in the IWM, or the small caps, pretty much all year. And except for a brief trip to new all-time highs up here that we saw in early November, ahead of some enthusiasm with infrastructure and ahead of enthusiasm of potential consumer buying ahead of the holidays, although that really hasn't turned out to be the case, we've really been sideways, which means what's so interesting to set you up for 2022 is which way this really, really, really long period of consolidation ultimately breaks. And so very rarely, we did an evergreen one for you recently about chart patterns, my favorite chart patterns, and clearly consolidation has to be one of the top ones. And I have to say, going back to the word rarely, have I seen a consolidation over a period as long as a year? Generally, the longer the consolidation, the more explosive the move. So the good news is you have two ways that you can play this with just a little bit of patience, and I would be patient. At this point in December, I don't know if I would necessarily go heavily short or heavily long, depending on which way the congestion breaks. I would more bank that we're going to stay range bound for the next couple of weeks, and that's going to create these choppy conditions that are frustrating so many traders. But nonetheless, as we get into the new year, if we break down under, let's say, that 207, 208, I think that you probably have, for the first time since we first heard about the pandemic in 2020, an opportunity to really go short with some conviction. So there are ultra short ETFs in every one of the indexes. That would be one way to go, because you could actually buy this ultra short ETF, or the inverse ETF, as a way to go short. You could actually just go short, or you can look for instruments that look like they're heavily ready to correct. People feel like you have to go to cash when things get rough, but when you have such a clear signal, like potentially what you would have here, I would say, if you've never tried being a little bit of a bear before, this would be a good time to do it. However, that doesn't mean that that's the way it's going to go. Anything can surprise us. Let's face it, the Fed is still relatively accommodative, and let's say inflation doesn't go out of control. And this then breaks out from, let's say, over 233. Forget about this little blip right here. I'm just putting my cursor along here. Over 233-ish would be type situation where you just buy. And you could buy the small caps, or you could look for value stocks, or you could look for small cap growth stocks, or what have you. But you might actually find the surprise where the big cap stocks go down and the small cap stocks go up. So that's IWM. Now, Granny Retail, she's having some different issues here. Now, again, there has been, if we take a look at 2021, where it started, 2021 started all the way down here. So retail started out weaker and then played some catch up. So I'm going to put my cursor here. This is a far trip down. So it's really not necessarily as clean as what we're seeing in IWM. So you go with the cleaner signals of cost. But nonetheless, if we take this last low of around 82 that we're seeing here back in March, that would be a level that you do not want to see break, number one. And number two, as you can see, we're in a strong distribution phase here because it's trading both under the 50 and the 200 DMAs. By the way, we do have an evergreen one on phases. If you don't know what I'm talking about, you can go dig in the archives for that. And so only if the 50 crosses below the 200 do we then get into a bearish phase. At this point now, this distribution phase is exactly that, the distribution of people raising into cash. However, I would say 90 would be pivotal area to watch. So if we're going to get any late December rally or early January rally, even in the small caps, we do have to see Granny Retail get back over 90. Now, this is probably, to me, of the three, the most interesting right here, and this is transportation. Number one is transportation, although it's been underperforming the SPY, is starting to catch up a little bit. We like when we see transportation outperform the SPY. Demand. Now, of course, the airlines have been hit, the hotels, the restaurants, and everything that has to do with normal life has been hit with the Omicron. But not too badly if you look at the overall index. And of course, partly that has to do with some of the railroads doing well. And even FDX, which has been trying to find a bottom. In fact, as I'm talking to you, it's up almost 6%. This could be a lead indicator. And those of you who have known me for years know that we have seen times this where if IYT doesn't fall apart, I can't get bearish. So right now we're still under the 50, but the 50 is sloping up. And if we can get back over, say, 267, 268, then perhaps, at least in the transportation stocks, and again, some of these stocks that reflect a normal life, which eventually we will go back to, and maybe sooner than we think, this would be, I'd say, one of the most positive things I'm seeing in the market. And of course, semiconductors, which has been the big leader all along, obviously never broke down like the others have. And you can see we have a tremendous amount of support here at around 276 to 280. If that breaks, that could drag the whole market down. But at the same time, this could also find some kind of level of trading range. It looks like we already have, while these other sectors like IWM and even more importantly, IYT start to shine. Something else to look for. What's kind of in between right here is like the regional banks, the whole financial sector, because the anticipation of the higher rates after the hawkish tone hasn't quite really played out, has it? Because if you look at the long bonds, which we will later, the yields are actually down, even though the yield curve is flattened. And yet regional banks wants to see higher rates. That's what they like. So at this point now, we're holding the 200. That's the best we can say. But as we're going into 2022, again, we'd have to look at a range. And in this case, I would keep track of the range more based on these two moving averages. Under 67, some trouble. Over 72, much better off. And then finally, to wrap up our family is the biotech space. And of course, you know, we've had Pfizer and all kinds of news about that. But look what's happening down here. We're not only outperforming the SPY a little bit here, but we've kind of made a new low, a mean reversion bottom. It was actually almost perfect down here at around 145, 146. I'm looking at the real motion indicator below the Bollinger Band and back up. So what I would do with this one, and on this one, you may not necessarily have to wait, is now wait for an actual legitimate bona fide phase change. Since it broke down under the 50 back in September, we've been below it. This is actually neutralizing in slope. And so if we get 2 closes over the 50-day moving average, then perhaps biotech is going to catch up. And it's sort of a cyclical and a non-cyclical. So if we go into any more difficult times in terms of the consumer, it's very possible that biotech could actually do much better. Now, if we move on to the SPY, of course, obviously SPY can't compare it to SPY, but you can see the momentum has declined, even though this is still in a bullish phase. So again, kind of range bound. If we put our cursor right here, we could see that this Bollinger Band, or around 450, is probably near the low of the recent range. And of course, you can see up here that 472, which was the all-time high level, is the top. If this breaks down under the 50 and breaks down under that 450, then it's probably not good for the entire market. But nonetheless, I always like to look for the outperformers versus the SPY, like I just showed you with IBB and IYT, and any classic relationships that we're grown up with, essentially. You know, these relationships can change. So now the next one, of course, would be NASDAQ. So NASDAQ has already broken down under the 50-day moving average, and yet it's still finding this level of support here at around 378. So that would be the real interesting twist. If Qs break down while IWM, which again started out red and is now green as I'm talking to you, starts breaking out. And if that's the case right here, it's going to have to get back over that 50 and then get through that 405 level. Otherwise, if it starts to break down under these levels here, I'd be looking next at that 200-day moving average. But more importantly, we can see that some of the underdogs are really doing a little bit better. And wouldn't that be fun? That would certainly be fun for traders like me who love to look for value, to see value stocks that have been really beaten up, like a Palantir, for example, actually start to perform. And it would also be good for, and I know we've covered this, Kathy Wood and her ARK fund, because she is in a lot of the disruptive technology, which not only has been beat up, but could also be somewhat of an inflation hedge if that actually comes to pass, because they don't necessarily pass on costs to the consumer. All right, I don't want to spend a lot of time on Apple, but I just wanted to go through some of the FANG. So you can see Apple right here kind of maybe found a top a little bit. 150 would really be the ultimate area. And if we can get through that 182, maybe it's got another leg up, but it would not be my favorite place to be looking to put money right now. Microsoft actually just broke down under the 50-day moving average. You know that these things are habitually watched, but for me, not necessarily the most exciting thing. Now, NVIDIA, of course, is a little bit different because it's a semiconductor, and we just looked at our semiconductor stock. But watch it on this 50-day moving average as we get into 2022, because NVIDIA could be set up for a correction, even though technically it's got everything going on for it. And what I mean that, I mean in terms of the company itself. All right, and then finally, since it's been in the news this week, and it was JP Morgan's top pick for 2022, I wanted to look at Qualcomm. And Qualcomm right here, also, I would find buying it around 160 a lot more palatable than getting in this sort of chop. I certainly wouldn't be chasing the new highs right here, especially as it's one of those big cap stocks. But 160, that could be an interesting situation too, because that also has made some good changes, a lot of it actually in terms of the automotive space and driverless cars. All right, let's move on to commodities, USO. Oil has come off a lot too, but I would expect that oil is going to hold. This is USO. It's not necessarily reflective of Brent crude, which is trading probably at around $72 a barrel. 70 has been the recent low. We get back through 75, maybe we see 85, maybe we see beyond. In terms of here, we're looking at, again, sort of a range between two moving averages, the 200 and the 50. So keep your eye on this going into 2022, because anything happens in the oil market, or the demand starts to rise, or there are shortages, or we get any geopolitical situations with Russia. I mean, anything could happen. This could also be an interesting place, and also would actually impact the metals and the inflationary narrative. And now let's look at the miners. So this is GDX. GDX had a really beautiful double bottom here, So that's a good thing. It got follow through this week and now getting a little bit more follow through, but running into some resistance here. Also had not quite a perfect mean reversion trade, but not a bad one. So if this is truly some kind of double bottom, you really want to see this thing now get back over this 50-day moving average and get into a more positive phase. Now, gold looks different because gold is having a different reaction here, but gold, and we talked about this. Now, why am I not seeing gold? Hold on. I want to fix my leadership indicator here because it switched to gold. It should be our benchmark, should be SPY. What we're seeing here is gold slightly outperforming the SPY. Also, now you can see that we've moved up in real motion indicators in terms of momentum, and we cleared the actual 50 and 200-day moving average. So what could happen here with gold, this too could wind up being a very interesting play as we go into 2022. And but gold has been fickle, as we've talked about many times. Gold has been in the type of situation where it likes to be bought on weakness and sold on strength. And so for right now, that's exactly what's happening. We got this good start to the day as I'm talking to you, and now it's coming off a little bit. So I would keep an eye on here, but I still think that gold could be interesting. And then of course we have to look at silver, because in inflationary times, silver will actually outperform gold. And that too, just like I showed you in DDX, has a double bottom here, but really will not start to show any kind of real interest until we can at least get back over this 50-day moving average in momentum, in price. And if we do it in momentum, that would be a good sign. And then, of course, in leadership. And finally, to wrap the commodities up, of course, you know, my favorite, I've done many features on this one, DBA, because I still think Mother Nature has a lot of havoc she's wreaking and will continue to wreak as we get into 2022. This is sitting here, digesting it on the 50-day moving average, offering a pretty good opportunity here. I think if we can get back up over, let's say, 1986, 1987, then I would say probably a good buy against the 50-day moving average to see if we can get back, fill this gap, and go on to new highs. Not a good scenario, of course, for our pockets, because it means that food commodity prices are going up, soft commodity prices are going up. Coffee's actually come down along with sugar, but nonetheless, this also has a grain component, and you'd want to see it outperform the SPY. All right, so I hope that gives you a lot of information. Let's just go quickly here through some of our outliers. So here's TLTs. The TLTs are actually slightly, they're kind of on par performance with the SPY. Again, sloppy chart. I don't know if I'd necessarily want to be trading this chart. Let's blow this out a little bit here. But this has been another one where you buy weakness and sell strength. This is a defensive play. So if we start to see this come off, that's actually a pretty good sign for the market, and not necessarily a sign that inflation is taking hold and rates are going to go up. Remember, rates need to go up. That's a good thing. It's the speed, the rate of change that we have to watch. And more importantly, we have to watch the junk bonds. Now, with the junk bonds here, I always find that I have to put this underscore to get a better picture. Now, this is a more accurate picture. So right now it is under the 50. It's still like on par performance with the SPY. It had a big gap this morning as we're talking, but you want to see this get back over 108. You want to see this hold 107.50, because this still means that high yield debt is being bought, which is a risk on environment. So if you're starting to think, wow, I don't know what to believe here in the market, welcome to the end of 2021, and hopefully things get clarified as we go into 2022. Now here's the 10-year Treasury bonds. You would think with all the hawkish talk, this thing would be down. You can actually still get a cheap mortgage, and it's actually outperforming the SPY. So to me, this also means that no one really believed that any kind of hawkish talk is going to have any great impact in terms of the interest rates at this point. And of course, we know that they can't do anything anyway till they end the taper. Now, let's also look at the dollar, because the dollar is another key picture to this. I usually like to look at DXY, but this is UUP, also on par performance, still doing well momentum wise, choppy. But nonetheless, to me, if this could break down under 25.50, that would definitely be a good reason to be looking at the precious metals and the commodities, and maybe even some of those other smaller cap growth stocks and small cap stocks that we talked about, and everything actually, because a more expensive dollar means our cost of goods are higher. But at the same time, if this goes back through 26, then perhaps the dollar will continue to go up. And of course, that brings me to Bitcoin. That's also been very interesting here because that's come off. It's kind of sitting here right on its 200-day moving average. And I'd say the range really here is between 44 and 52. If it can get back through 52, that would be very bullish. If it breaks down under 44, I think we can see 40, maybe 39, 38, and then we would have a fresh look. But for all the talk about Bitcoin, obviously we have to keep in perspective that this is still up tremendously from the beginning of 2021, and especially if we look back at 2020. So again, if you get some perspective here, you can see that we're just trying to find really where the value of Bitcoin is going to be going forward. And then finally, I'm going to wrap it up with VIX, because I get constant questions about should I be buying volatility? And I keep saying no, not until we're 100% sure that we're bearish should you be buying volatility. Because right now, you could see right here what's happening. Volatility gets these big moves on these 1 to 2, 3, 4 day type of situations, but it's still really cheap, which means there's still no real fear in the market. And until we see that, and what would really get me more convinced would be maybe if we can have a couple of sustained closes, let's say above this 27, 28 level, or even clear this 200. Right now, as I could say, keep your eye on where the strength is coming in. Look at the idea of the small cap versus the big cap. Look at the idea of what could possibly happen with some of the commodities. And then look at some of these tech stocks, like I had mentioned to you before, that have been beat up, but could be making a huge comeback.
So with that, it's a wrap. I hope all of you have a very wonderful holiday and a happy and healthy new year. I look forward to being with you each week as we get into 2022. Thanks so much for all your support, your great comments, and I will see you soon. Bye for now.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.